The man, the myth, the legend. The guy who shorted the US economy and made billions when the stock market crashed in 2008. Let's see what he has to say and advice he can give us when it comes to investing. So, in this video, we'll be talking about the 5 key lessons from Michael Burry and the way he goes about his investing. Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started. Lesson 1. Don't be a copycat investor. So, of course, we don't go out and buy stocks based on what other people are saying or advising. However, don't feel compelled to copy the strategy of another investor. Simply keep to your own interests and strengths. As Michael Burry observed in Michael Lewis's book, The Big Short, if you want to be a successful investor, you have to match the style to who you are. It's also worth noting that despite having every benefit in learning from Benjamin Graham, Warren Buffett did not follow in his footsteps, but instead charted his own course and ran money according to his own set of rules. This is critical because while another investor's technique may work for them, it is unlikely to work for you. For example, Warren Buffett has an incredible investing approach. And as a result of this plan, he invests in banks because not everyone is familiar with banks. Simply imitating what he's doing with his investments won't work for everyone. Steve McKnight is a well-known Australian real estate investor, and his method is rock solid and profitable for him. It is unlikely that it would work for us. We don't know much about real estate after all. So while you should listen to what these folks have to say and learn from their investing views, you should avoid trying to emulate them. Concentrate on your own skills and experience in the companies that you want to invest in. Lesson number 2. To be a good investor, you have to learn about it. Yes, you'll never be a great investor if you only follow instructions. You'll need to do your own study and write your own guidebook. I soon internalized the idea that no school could teach someone how to be a good investor, Michael Burry continues, returning to the massive short. If this were true, it would be the world's most well-known school, with tuition that is unaffordable, and as a result, it's impossible to be true. This is simply not the case. At the end of the day, you must write your own manual. You must be the one who understands how to invest independently. That isn't to say that you can't benefit from the experiences of other investors. In fact, analyzing these great investing names and identifying common traits is an excellent method to begin developing your own investing guide. Those are a few of the most frequent investment approaches. For example, Warren Buffett believes that you should only invest in your area of expertise. You must know what you own, according to Peter Lynch. You should never invest in a company that you don't understand, according to Charlie Munger. These investors are no longer following in the footsteps of one another. It's only that based on what they've learned over the years, they've created their own instructions and how they learn to invest. All of them come to the same conclusion. And we might observe it and think, you know what, that is a logical conclusion. We need to understand a company before we invest in it. Let's stick to what we're familiar with. Overall, you have to teach yourself. Lesson number 3. You need to have confidence. To be a genuinely outstanding investor, you must have the confidence to stand up and support the investments you make. There are 2 types of confidence. The first confidence is comparable to arrogance in that you stand up and proclaim what I believe is true and is definitely accurate, no one else is right, yet you have a different position. The second type of confidence comes from putting in the effort and conducting significant research on the topic or outcome you're betting on, and almost having that self-confidence as a result of the effort you put in so far. The first confidence, which is arrogance, includes failing to consider other people's perspectives. This can be detrimental to investment and will lead to losses. On the other hand, if you want to be a successful investor, you must have the second form of confidence. And as I previously stated, it all boils down to really going out and doing the research. I believe that a mortgage that enticed subprime home buyers to buy would emphasize the housing market's peak. Monthly payments were near zero, with a teaser rate since subprime mortgages were turned into securities. Burry learned about the industry through regulatory filings, which were necessary. Due to a shortage of credit, mortgage and refinancing options would eventually come apart, causing home values to plummet. He didn't skip a beat in his investigation. He had to study mortgages and mortgage-backed securities for years before he was comfortable with them. Learn about credit default swaps and the state of the American housing market. While everyone else says housing is strong, what are you doing? He would say, actually, the system is defective. And I have the confidence to take this step because I've done my homework and studied all of the choices, he added. And I know that I am correct. Burry has full confidence in what he knows. Lesson number 4, don't be afraid to be a contrarian. To do very well in investing, usually you have to go against the grain. This is the kind of building on that point that we were just talking about, where it's all about confidence because it's the confidence that you get from going in and going that and doing that in-depth research that enables you to stand up and be confident in going against the grain. And again, that's what Michael Burry did. He saw that everyone in 2008 was saying, but he was not afraid to go against the grain and be a contrarian because what you kind of realize after watching the stock market, how it works, and how Wall Street works, you realize there is a big herd mentality. People may not accept it, but it is the situation. Usually there's a way of thinking, whether it's about a certain stock or an entire industry, that gets on and becomes the consensus. And a lot of folks don't actually do the study to see if the consensus is correct or incorrect. They just follow the herd. So even in the realm of investing, a lot of people are just following the herd. And the problem with that is that occasionally the herd just walks straight into an avalanche. And this is obviously exactly what happened in 2008. In 2008, Michael Burry went against the grain. He had the confidence, he did the research to be the contrarian, and he profited very handsomely from the events that took place through 2008, 2009, and so on. Lesson number 5, don't be afraid to look for value wherever you can find it. Michael Burry, for example, has studied the property market in the past as well as US technology equities. He's looked at stocks in Japan and Korea, and he's even looked at water as a commodity. And he's employed financial instruments like credit default swaps, derivatives, and options throughout his career. He's bought just regular old shares. So the point is that Michael Burry isn't someone who sits around waiting for the one stock he's been eyeing on to go on sale. He might wait 5 years for that golden opportunity, and then he just buys the shares and holds them for a long time. He's always looking for value wherever he can find it, and then he figures out what is the best financial instrument he can use to profit as much as possible from this thesis. And the thing with Michael Burry is that he constructs this investing thesis betting on some particular outcome to occur, and then after he's done with that, he figures out the best possible thing to buy to best exploit that, the potential hypothesis that he thinks is going to come to fruition. Talk about looking for value wherever you can find it. This definitely doesn't mean you want to go and reach outside of your circle of competence. Just try and find something new. Like maybe devote an hour a week towards your investing. You can only stay up with the industry in which you work, so maybe there are only a few companies in which you feel comfortable keeping up with. That's perfectly fine. But something that's extremely intriguing that I've discovered about Michael Burry is that the whole notion of finding value. He starts with that basis and then he works out how to investigate it, how to best profit from this outcome, and he conducts his research and he really makes sure he understands the best manner that he's going to be able to do just that. Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.